Chris Volk, shares of Store Capital are up over 23% year to date. Most REITs are doing well in this yield-starved environment, but you're doing exceptionally well. Why is that?
Growth. We've increased the size of the balance sheet hugely. We've raised our dividend 16% since we went public in 2014. That's a big number.
And last week you made the announcement that you're raising your dividend by 7%. I think your yield is over 4% now with that move. What does this say about your outlook and your dividend plans going forward?
Well, the outlook is positive, and what we've been trying to do is grow the dividend, but not grow it as fast as the cash flow per share. So actually the dividend's been more protected. So we've not only had growth that's been at the leading edge of the sector that we're in, but then on top of that we've been able to protect the dividend even more, which is terrific.
And you received an investment grade rating from S&P. So how does this improve your financial flexibility, and what do you plan to do with it now that you have a better rating from S&P?
Well, S&P is not just a better rating, it's the first time we've been rated. We had a BBB- rating from Fitch, so we're adding to that the BBB- from S&P, which by the way has a positive outlook, which we're excited about. And we're going to use it to continue to expand our unsecured debt borrowings. So we did 2 series of long-term debt on the unsecured side. And by the way, I should say, Greg, we have a single A+ conduit on top of that. So we have all kinds of investment grade options that will allow us to grow the company.
And you own properties across the country, and mostly, actually primarily, you deal with single tenants, restaurants, drugstores. So you speak to a lot of them on a daily basis, I'll assume. What do they say about the economy?
Our customers basically are looking at the economy as sort of a status quo kind of economy. Their cash flow at the unit level, cash flow corporately tends to be stable. I've been telling a lot of guys that flat's the new up. So, and when we've done this, we've always known the economy is a little fragile, maybe fragile for a long time. We've run companies like this, public companies, for 20 years. We've run businesses like this for 30 years in every cycle you can imagine. And our customers are as solid today as they've ever been.
And what are they worried about? Where do their worries lie?
They're worried about everything from insurance regulation, healthcare, in other words, minimum wage increases, anything that's going to increase the costs of them to run their business, and ways to run the businesses more efficiently. And because of that, what we're doing for our customers is next year we're actually going to have a conference with people coming in to talk to them about things that are actionable over the next 12 to 24 months.
And you make it more efficient for them to run their businesses because you take away their real estate worries. They don't have to own a property or worry about that. They can just run their chain.
That's correct. And it's not just real estate worries. It's having a flexible, breathable balance sheet so that companies, in lieu of owning their real estate, can actually be more flexible with us owning the real estate. It sounds counterintuitive, but it's not.
All right, and then finally, this week you're launching something called Store U. What does that entail?
Well, Store University is a pet project. It's got 10 classes. I've recorded 7 of them, so I'm getting into the recording business. And every class is about 20 minutes long, about 4 or 5 sections to each class. And we'll start off with how to value businesses. We'll move into how to calculate returns on equity, things that are going to allow our customers to better evaluate their businesses and to get richer.
All right, well, thanks a lot for coming on and talking about it.
It's a pleasure. Thanks so much.
And thank you for watching The Street.